Good afternoon, everybody. It is Wednesday. It's about 4 o'clock, and the market is all closed. And I've got some great information for you today because when the Fed typically lowers rates, mortgage rates actually go up. And this has been happening multiple times. You can actually see a video I did when the Fed last cut rates. So let's talk about what happened today, what's happened over the last week, and why rates have actually gone up. So really and truly, the gist of it is rates have gone up because the market is forward looking, which means the bond traders, the stock market, they've already cooked all of this rate stuff into the books over 30 days ago. This here is as you see, is today's market rates. So this is a Japanese candlestick chart. This is an inverted chart, which means as this chart goes down, interest rates go up. And you can see throughout the day today, these are 10-minute intervals, it was flat. Absolutely flat. Then we get the initial bounce, and then 10 minutes later, after the initial bounce, everything starts worsening. And you can see that rates actually start worsening. I've had multiple lenders worsen from anywhere from an eighth to a quarter of a point. Every one of these URs is a lender that has worsened their rates today. So if we look back a little bit on a 5-day chart, this is a 5-day chart. As this chart goes up, interest rates improve, and again, as this goes down, interest rates worsen. So we knew they were going to do a quarter point. That was actually cooked into the books, as we like to call it. What we were curious about is if they would do a half a point, and it doesn't look like they're doing a half a point. Then additional information came out, what was called the dot plot chart, which means each member of the Federal Reserve is plotting for the next year where rates are going. And right now, the dot plot indicates that no further rate cuts are going to happen this year. And there might be some further rate cuts in the future. Now, what does this really mean for interest rates? We've actually seen rates improve over the last 3 months. So this is the last 3-month chart, and you can see this chart has gone up, which means interest rates have gone down. And that's really good. What we're probably going to see over the next 30, 60, 90 days is some stability or some flatness in the market, which means we're probably not going to see rates adjust much from here unless two things happen. First thing, we get some really, really horrible unemployment numbers. And unemployment comes out on the first Friday of the month. Second thing, consumer price index and a little bit of the personal consumption expenditure. This is inflation. If we see inflation continually rise due to wage inflation, due to tariffs, due to just general inflation, interest rates are going to continue to go up. If we see inflation start coming down and we see the job market getting really, really crappy, we can start seeing mortgage rates come down. So I hope this kind of makes sense to you. We watch rates on a daily basis, and that's our job. Anyways, I'll have more information on Friday's update. Thank you. Make it a great day.